All right, let's talk Dutch Bros. Their Q3 earnings just dropped, and man, it was a wild one. You had a report that sent the Bulls and the Bears straight into the ring, and today we're going to break it all down. So here's how we're going to do it. First, we'll tackle that really weird market reaction, the beat and fade, as we're calling it. Then, we'll dig into the numbers that made the quarter look so strong in the first place. After that, we'll look at management's playbook for growth, try to figure out why the market got so spooked, and finally, we'll wrap it all up with our take on what's coming next. Okay, first up, a beat, but a fade. Seriously, this quarter was a classic puzzle for investors with some really mixed signals. I mean, you look at the results, and on the surface, everything looks fantastic. Dutch Bros delivered a beat and raise. That's the dream scenario, right? But then, the stock just tanks the next day. So the big question is, why the heck did it drop? And check this out. Right after the earnings call, in after-hours trading, the stock pops up 4%. You'd think everyone's happy, right? Nope. The very next day, a complete 180. It closes down over 4%. That kind of whiplash is exactly what we need to get to the bottom of. So let's move on and unpack that strong quarter. We need to look at the numbers that built the bull case and got everyone so excited in the first place. First off, revenue growth was just on fire. We're talking a 25.2% jump from last year. That's huge. It blew past what Wall Street was expecting. And it wasn't just the top line. The bottom line, their profitability, looked fantastic too. Adjusted earnings per share, or EPS, came in at 19 cents. Again, a really nice beat over what the analysts were predicting. So let's just recap here. You've got revenue, that's a beat. Adjusted earnings, another beat. And then you have same-shop sales, a really key metric, up a massive 5.7%. I mean, on paper, they just absolutely crushed it. Now, this is the really important part. This wasn't just them jacking up prices. No, this was their fifth straight quarter of positive transaction growth. More people are actually coming through the drive-thrus. That's the real engine here, and you love to see that. Okay, so with numbers like that, management's job on the call was pretty clear. Convince everyone this isn't a fluke and that they have a real plan to keep this train rolling and to justify that high stock price. And their strategy really boils down to 4 key things, all centered on growth. First, grow people. Keep that unique barista culture alive. Second, grow shops, and they're being super aggressive with that. Third, grow transactions, bringing in new menu items and using tech. And finally, as they get bigger, grow margins. Simple but powerful. And you heard this straight from the CEO, Christine Barone. Her whole point was, look, you can't just lump us in with other fast food places. She's basically arguing that their culture and their growth model put them in a totally different league. So how are they getting all these people in the door? Well, it's not just one thing. Their digital and loyalty program is an absolute monster. Get this, it's involved in 72% of all transactions. Think about the data they're collecting. They're also killing it with menu innovation. Their fall launch was their biggest ever. And this new food program they're testing, it could add a 4% lift to sales. That's a huge deal. But really, the entire growth story comes down to this one massive number. Their goal is to hit almost 2,030 shops by 2029. I mean, that's basically doubling their footprint. That is the bull case in a nutshell. So, if everything's so great, what happened? Why the sell-off? Well, this is where we have to start reading between the lines of the earnings report. Okay, here's the first clue. That adjusted EPS number we talked about before, that was a clear beat. But the official number, the GAAP EPS, actually came in a little light of expectations. It's a small detail, but for the pros, it's a detail that matters. And then, during the Q&A, you started to hear some other things that gave investors pause. Management admitted that high coffee costs are going to stick around into 2026, which hits profits. All those new stores? Well, they cost a lot of money to open. And that promising food program? Yeah, it's cool, but it also means more complexity and upfront costs. Suddenly you've got a few clouds on the horizon. And this right here, this is the whole story. A price-to-earnings multiple of over 100. What that means is the stock is priced for absolute perfection. There is zero room for error. So when you start hearing about rising costs or margin pressure, even if they're small, it's enough to make people sell first and ask questions later. The valuation is just that high. All right, let's pull all this together and talk about what comes next. What's our take on the next earnings call and beyond? So what are we watching for in Q4? We think revenue will still look good, but all eyes are going to be on those profit margins. Is that cost pressure starting to show up? We also think the stock is going to be choppy, caught in this constant tug of war between the growth story and the valuation concerns. And the big number everyone's going to be watching for is that 2026 new store guidance. They've got to hit it. So where do we land? For us, it's a market perform. Look, the company is executing really well, no doubt about it, but that premium valuation combined with those cost headwinds creates a balance. We think the stock is probably just going to move with the broader market for now, until this bull versus bear debate gets settled. This is not financial advice.